Welcome back to EDS, and in this video I'm going to show you how to grow a small portfolio by writing options contracts and collecting premium upfront like an insurance company. So what you want to do is open up any equities underlying in your brokerage platform. We've got BA open at the moment, Boeing. It really doesn't matter what you pick. The reason why is because we're only interested in the expiration dates at this stage, and all equities have the same expiration dates. So we want to pick an expiration date that's going to be between 30 and 60 days out in time, and it also needs to be a monthly, not a weekly or quarterly expiration date. Now the only one that actually fits that criteria right now is February 21st with 49 days left on the contract. So we can take that information, come over to our watch list and simply filter out any and all underlyings that have an earnings event over the next 49 days. And the reason for this is simply because we are shorting these contracts, which means we are selling high and buying low. Well, that's the idea. Now, volatility increases as we get closer to an earnings announcement, and when volatility rises, option prices also rise. So if we're already in a position and we have an earnings announcement coming up, that will negatively affect our P&L, at least in the short term. But then once the announcement's done, it can also mess up our deltas. So for two reasons, we want to avoid earnings. And we also want to remove anything that has a low liquidity rating level. We are only interested in trading liquid markets. The more liquid a market is, the tighter the bid-ask spread is. And the spread is simply what you pay every time you get in and out of a position. So the tighter the spread, the less you pay, the more profit you keep. Now, at this point, I like to order everything from high to low IV rank. This is a matter of personal preference. We simply want to sell contracts on underlyings that have a nice and high IV rank. And you want to also keep in mind what's already in your portfolio. You want to keep everything nice and diverse. Don't be too heavy in any one sector or industry. Use common sense and you'll be absolutely fine. Now, straight away, XLE is standing out to me, trading at just over $87 a share. It's got a nice IV rank of 39.7 and an absolute IV level of 20.7%. So let's have a look at XLF. Let's open up February 21st, as we've already decided at the start of the video. And now we are presented with the options chain. We want to ensure we have a high probability of success. So what we want to do is we want to use this vertical orange bar, which is the expected move, and that simply shows us what the expected move is of XLE over the next 49 days. So we're going to be writing contracts, and we don't want price to go anywhere near our contracts. We don't want price to breach our contracts. So what we're going to do in order to get a high probability of success is we're going to choose strikes to sell our contracts on that land outside of the expected move. And we want to be in and around the one standard deviation level, which, as you can see here, is indicated by the blue dotted lines. And we can also use delta. I like to be anywhere between 15 and 20 deltas. And all three things typically line up quite nicely, as we will be able to see here. So on the call side, we've got a 19 delta at the 94 strike. And on the put side, we have a 20 delta at the 82 strike. So what we can do is be a little bit more conservative, because we have got a 16 delta as well. So we can go one strike further at the 95, one strike further out at the 95 on the call side, and we can go to a 16 delta on the put side as well. So you wouldn't be wrong with going with either the 16 or the 20 delta. It's just, it depends on how much premium you want to collect up front and what your probabilities of success are. So as we can see, our contracts are sitting outside of the expected move here, and we have a pop in the bottom left corner of 74%, which means we have a probability of profit of 74%. And what that means is at the point of expiration, we have a 74% chance of making at least a penny on this position. And if we want to get out of this position early and not wait all the way to the expiration, then we have a probability of making at least 50% on this trade. Well, a probability of 85%, of making at least 50% on this trade. Lots of percentages. So we're looking at probabilities of success between 74 and 85%. So very, very high probabilities of success here. We'll collect $120 upfront in premium, and our broker is going to require 1.1k, just over 1.1k in buying power. So we're getting over a 10% return on capital for a naked strangle, which is quite nice. If we want to be a bit more aggressive and go to the 19 delta and the 20 delta, we can do so. Our probability of hitting 50% doesn't really change too much. Our pop reduces a little bit, but we collect more premium up front. So now we're collecting $1.50. The buying power requirement does increase slightly by $100, but we're collecting more upfront, which gives us a nicer return on capital. Now, 1.2k might be too much for your portfolio if you have a small portfolio. So what you can do is you can say come $2 further out of the money, say the 96 strike. We can buy that contract. We can use some of this premium to buy that contract. And we can do the same thing on the put side. We can buy the 80 strike, which is $2 wide. And now, as you'll see, our buying power requirement has significantly been reduced. And the reason why is because we have now defined our max loss. And it's defined by the width of the strikes, between the width of the strikes, meaning the difference between the short strike and the long strike, which is $2 minus the premium that we collect up front, times by the contract multiplier of 100. Each contract controls 100 shares of the underlying for equities, and that gives us a max loss of $146. Our broker knows this, and so they're only going to require that amount in buying power. So now if you look at the numbers, we will collect $53 on entry, and our broker is going to hold $148 in buying power. So we have a much higher return on capital by doing it this way. And in turn, we have a slightly lower probability of success, a pop of 60, and a P50 of 80%. So slightly lower probabilities of success, but a much higher return on capital. Now, this is essentially the trade-off that we're making. This is the difference between a naked and covered position. However, if you have a small portfolio, you may not actually have the choice. You may have to go with a covered position, simply just due to buying power constraints. Now, how do you know how much buying power you should be allocating to each of your positions? Well, in order to figure that out, we've created a free position sizing template. That the link is in the description. It's available for everyone to get a copy of. And the way it works is you enter in the size of your portfolio. Say you've got $12,500. You then enter in whatever the current VIX level is, and everything below will then be automatically calculated for you. And all you need to do is use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power you should be allocating to any single defined risk position, undefined risk position, and also the amount of your portfolio that you should be allocating to short premium strategies at any given time, which does change with respect to what the VIX is. So as long as you follow this, you'll be absolutely fine. If you want to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium, get yourself signed up, and inside you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, and how we're making adjustments all in real time. We have got a small portfolio live inside EDS Premium right now that we're growing. So anyone with a small account, feel free to join and copy our positions and grow your account alongside us. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know. It is a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee. So once you have studied the full course and followed our trades for at least 6 months, if at that point you aren't profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free. It's £1 a month to join at the moment. It's so cheap because we've just launched. However, price will be increasing. And once you're in, the price is locked in for you for life. The aim of EDS Premium is to get you to a point where you know what you're doing. You don't need any external help or influence. You've learned the skill. It's something that you can do for the rest of your life. No one can take it away from you. And we aim to get you to that point within 6 to 12 months. You are always welcome to stay and be a part of the community, but 6 to 12 months and you should be good to go. So with that being said, I will see you guys on the inside.